Holy 30-year fixed rates just hit 8% for the first time since 2000 as Treasury yields soar towards 5% on the 10-year. So why do interest rates continue to climb, and what kind of threat does this pose to the economy as well as to the housing market? Well, that's exactly what we're going to dive into in today's video. We somehow continue to crush expectations week over week, with the most recent being that US manufacturing beat expectations, along with retail sales obliterating expectations, in addition to total housing starts and permits also coming in higher than expected. And once you add all of those data points along with the fact that JP Morgan just revised their Q3 GDP forecast going from 3.5% to 4.3%, along with the Atlanta Fed GDP now coming in at 5.3% for the third quarter. Now, something to keep in mind here, GDP should typically rise around 2% per quarter. And if we actually take a look back over the past year, GDP has been running around 2% per quarter, but now with the forecast of 4.3% from JP Morgan and 5.4% from the Atlanta Fed now, it doesn't really show signs that the economy is slowing down, which in turn gives the Fed additional ammunition to continue to hike rates. And that's exactly why you're seeing the 10-year Treasury move higher. But here's the crazy part. Powell says inflation is still too high and that lower economic growth is still needed in order to bring inflation down. And along with that, you have the Fed's Bostic saying, I don't believe we'll need to cut rates until the middle or end of next year. And because of this hawkish stance, we've seen interest rates move towards 8% as mortgage demand falls to the lowest level since 1995, which in turn has caused US mortgage applications to hit a 28-year low. But here's the thing, anybody that thinks this can continue for an extended period of time clearly doesn't understand how much high interest rates impact the economy long term. Now, before we dive into that impact, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. Also, feel free to subscribe to the channel to stay updated on the economy, on the Fed, on interest rates, and everything housing. Total federal interest expenses should rise by about $226 billion over the next 12 months to $1.15 trillion. But for context, from the second quarter of 2010 to the end of 2021, when interest rates were near zero, the interest expense rose by $240 billion in aggregate. But here's the crazy part. Interest expense has increased more in the last 3 years than over the last 50 years. Now, if we take a look at this graph here, projecting interest rate costs as a percentage of tax returns, you can see the government has no choice but lower for longer interest rates. Because at the current level, if they continue this same pace, they're going to bankrupt the nation. Now, with that said, that doesn't mean interest rates are going to drop immediately. In fact, there's a really good chance that interest rates do stay higher for longer. But here's my thoughts on that. The higher they keep them for a longer period of time, the more violent that shift is going to be when something actually breaks. At the moment, with our government debt rising, over the next 3 years, the federal government will be spending more money to service its own debt than they spend on Social Security. And as the pace continues within the next 5 years, it's going to be more than the budget for the Defense Department. So I realize that a lot of the reports out there right now are showing the economy doing very, very well, which still baffles me somehow. But the reality is that's what the reports are showing. So I'm not denying the fact that the economy still looks really, really strong on paper. But I know that as a nation, we can't continue to just pile on debt after debt after debt with absolutely no recourse. At the moment, we're talking about giving additional funding to Ukraine along with Israel. And I realize these countries need help, but I also look at us as a nation. We're $33 trillion in debt, with that number continuing to go up, which tells me that the Fed can only continue on this pace for so long. So in the short term, you're likely to see the Fed remain hawkish because they're not necessarily looking out into the future to see what this debt is going to do. They're looking at right now, and what they're seeing is employment higher than they want to see it, along with inflation remaining above their 2% target. And because the Fed seems somewhat divided on what the future looks like, that's creating additional volatility in the market, which in turn isn't good for interest rates. So how does this higher for longer mentality with interest rates affect an already broken housing market? Well, at the moment, housing has never been this unaffordable. And Goldman Sachs believes that house prices are likely to continue rising, as housing prices just peaked for the 6th straight month in September. But here's the thing, the way they calculate home prices year over year, you're likely to continue over the next couple of months to see year over year increases. It's going to show that home prices are getting more expensive, when in all reality, home prices are already moderating and likely to decline year over year as we start to see new data in 2024. But there's something to understand when I say that. I'm not talking about a crash, I'm just talking about some markets getting affected a little bit more than other markets as interest rates continue to affect affordability. The only real crash that you're going to see in the market is already happening as home sales slide to the lowest pace that we've seen since 2010, with existing home sales falling to a seasonally adjusted rate of 3.96 million in September, which is a year-over-year sales drop of 15.4%. And if it couldn't get any worse, home builder sentiment also dropped to a 10-month low. So you got inventory sitting near all-time lows, you have demand sitting near all-time lows, and you have home builders not willing to build houses, which is essentially the one solution that could solve this problem long term. Now I realize a lot of this sounds like doom and gloom. We talk about rising interest rates, we talk about the economy suffering long term, we're talking about housing not really getting any more affordable, but understand there is some light at the end of the tunnel. It's just not going to happen immediately. So what's the good news that I'm talking about? Well, mortgage bankers are expecting the 30-year fixed rate to drop back in the low 6% range by 2024. And because of that drop in rates, you're likely to see mortgage origination improve by nearly 19% next year. But here's the thing, I understand how much mortgage costs affect your mindset and or your ability to actually buy a home. And in many markets out there, it's cheaper to rent right now than it is to own. So you have to decide as a potential home buyer, do you want to be a renter or do you want to own a home? And the answer could be, I want both. I just want to rent in the short time until things improve. And that's completely understandable. You have to always do what is right for you. For me, right now, I'm in the process of buying another home. And yes, I'm taking an interest rate over 7%. Unfortunately, but for me, it's the right time in my life. It's the right time for me to upgrade to that next home that we've always wanted. And my mindset behind it is at some point, interest rates are going to come down in the future and I'm going to be able to refinance and take advantage of those lower rates. Now, fortunately, I'm in a position to take on a higher monthly payment. Some of you watching this video might not be able to do that. And it's completely okay sitting on the sidelines and dialing in everything else until you're ready to take on that decision. Buying a home is an emotional process. So instead of watching the news media and reading the headlines, instead focus on things that you can control. Try to get your credit dialed in, try to save for a down payment, get your budget in order, because if you pay attention just to the media, it can all make it seem like it'll never be possible. And in all reality, things will improve. It's just going to take some time to do so. So in the meantime, if you're one of those people sitting on the sidelines waiting and you're not quite ready because of where the market is, but you're looking to educate yourself, I created a first-time homebuyer course to guide you through that process. Everything you need to know from A to Z so that when you're ready to buy a home, you have the knowledge and expertise to do so. So if that interests you at all, do me a favor and check the link below. Now, if you're a buyer that's currently out there in the market at the moment, what I would say is you're likely to see a market like this for the foreseeable future. Interest rates going up, interest rates coming down a little bit, home prices moving sideways, up a little bit, down a little bit, but not really seeing a huge improvement in either. So understand, while there are a lot of negative things right now in the US, like high interest rates, like high home prices, like unaffordability being at all-time lows, it's always good to put things in perspective. And remember, things can always be worse.